All right, here we go. Back again. This is a live show, and so you can tell sometimes I think it's fun to just tune in to see what happens as far as that goes. So here's the S&P 500 so far year to date, and what we have here is a breakdown of the market overall. We can see that it's been coming down since the beginning of the year. It actually hit the all-time high there on the 3rd of January. The 200-day moving average is that blue line, so we're below the 200-day moving average. The 200-day moving average is moving down. To me, that means the major motion of the market is down at this point in time, and the minor moves are up. And so you can see that we've had many little upturns here, all of which have failed in the end and came back down. And so until we kind of reestablish the new major trend to the upside, it's time to be cautious as far as I'm concerned. We did hit a low back here in June. Maybe that's the all-time low. We'll have to see what happens. But you have to be a little bit cautious here, assuming that that's true and not jumping back into these motions that are happening. We have seen this week essentially, 4 days down, and today's up, and we'll talk about why here in a moment. But overall, over the last 2 weeks, if you look at that, we're kind of just going sideways, right? We're just kind of churning through time here, kind of waiting to see what directions we're going to take. And essentially, it means there's an equilibrium between, the sellers and the buyers, and there's different reasons that, people would have for that. But here's what we're happened so far this week that I'll share with you that I think is interesting. So first of all, this is the year-over-year consumer price index number. And what this represents theoretically is the inflation on the things that we buy. Personally, inflation is really a personal thing. It depends on what you're purchasing altogether as to what you really end up experiencing. But we see here that it's up 9.1%, which goes, back to the 1980s, early 1980s, since you've seen anything like this. So obviously, inflation is very, very high. It is the major issue that's happening with the stock market. And this number was reported on Wednesday. So this is a big number that people wait for to see what's going to happen. And the other thing we look at here is that, basically in March, thought we were at the all-time high for this, year. And then, of course, it dropped a little. Okay, that looks good. But then it went up in May, 8.6%. Now it's gone up in June. Now we're again talking about, okay, maybe this is the high for this time period. Things are going to fall. And there's some reasons that people are talking about the fact that this could be the high as far as that goes. And one of which is the fact that what they call core inflation, which is just the headline inflation, which we just looked at, minus food and energy. Core inflation is down again. It was down in April, down in May, down in June. Still very high, actually, at 5.9%. That's really again back to the 80s since you've seen core inflation that high. But the direction is to the downside. So what the Federal Reserve is doing is starting to work. There's starting to be some pullback in terms of the cost of some of these areas. We're seeing wage inflation, which is probably the most difficult to get rid of, not really going that fast. So in other words, wages grew at about 6% a year at one point here during this pandemic recovery, and that's down to about 4% now. And so that's a good thing in terms of the possibility of the Federal Reserve being able to kind of back off. But the core inflation is a big issue. And so really, if core inflation is coming down and headline inflation is going up, that means food and energy are the big driver. And specifically, we look at gas here, and you can look at diesel, you can look at natural gas, oil, all of these things that fit into that category. But gas peaked out in the middle of June. And so when we look at the CPI, headline inflation, including food and energy, it was up a lot for June, but it's sort of a backward-looking, index as far as that goes. Right now, we see that gas has come back down. However, I would caution you, because if you look back on that chart just a little bit, you can see that it peaked out in March, came down, and then went higher. So just because it's coming down right now doesn't mean it's going to stay down or go all the way back down, or we're going to have some reasonable price for gas. And I do think this is one of the key things to watch. Again, the direction, like core inflation, is the right way right now, which is good. But what actually happens here as far as that goes. So I feel that this is the biggest threat right now to what could happen to the stock market. And that's specifically because of the Russia-Ukraine situation. So you have a scenario where J.P. Morgan has done a study, and they looked at the possibility of Russia kind of weaponizing oil. So if they cut back $3 million barrels a month, the projection was that oil would go to $190. Well, it's at 97 now. And so that would make, essentially gas nearly double in potential, motion, which would be dramatic to the economy, to everybody's pocketbooks. They also said, again, 11 million is what they're producing. If they cut that back by 5 million, that oil prices could go to $380 a barrel. Again, imagine gas costing 4 times much. Not saying that gas and oil are directly related, but they're very heavily related. So that's the biggest threat. If you had a situation of $7, $10, $20 gas, whatever that might be, diesel, all these things, because everything takes energy to be produced and to be delivered and shipped around the world and brought to your store or to your door, whatever it might be. And so when energy prices go up, it just sucks money out of the economy. The energy producers make money, but everybody else is making less, and everybody else has less to spend on other things. Maybe if your gas costs are so high, you stop going to restaurants as much or going out to movies or going on a trip because you really can't afford it because you're spending so much money on, warming up your house or cooling off your house or whatever might be happening. So that's the big threat that we have to watch for. You'll see it here in this gas price probably very quickly. Certainly watch the oil price. And we're already seeing some of these threats happening where Russia has started to cut back on some of the natural gas production deliveries and what have you too. So we'll see how that plays out. The market is up today. This is one of the big reasons that it's up today. The consumer spending number came out, and the retail and food services sales versus last month are up 1%, which is a really pretty good move altogether. And so this is kind of fascinating because what's happening is essentially, if you look at the consumer sentiment surveys, the basic answer to the survey is my financial situation looks bleak. I am very concerned about what might be happening 6 months from now, yet they're going out and spending money anyway, right? Because the pocketbook is kind of more important to me than the surveys, although the surveys are part of, most of these leading indexes have a consumer survey in them because they have proven to be a good forecasting tool, so we'll see what happens. But there's a lot of pent-up demand, right? I mean, people want to go do things. They want to go to restaurants. They want to go to movies. They want to go out to eat, go travel. And so, at the beginning of the year, had quite a bit of cash in the households and in the businesses, and some of that has been dissipated now. And we're starting to see reports that credit usage, whether it's car loans or credit cards or those type of things, is going up on a household basis. And so people are just going for it. They're going out there. I don't see that stopping. But here's the problem with that. The Federal Reserve is trying to bring down inflation. If we keep going out and spending and spending and spending, that's going to fight what the Federal Reserve is going to do. The Fed's just going to push even harder and keep raising rates and raising rates. And then all of a sudden, we might stop spending. And so we can stop spending a lot very quickly if we wanted to, right? And the impact of what the Federal Reserve, so they're supposed to maybe raise rates this much by 0.75%, right? That won't have an impact for 6 months. So then to come around in September for the next meeting, maybe they raise another 0.5%. That doesn't have an impact for 6 months. But in between time, the consumer could start to pull back. And that's how you get these bigger recessions, because there's this big lag for what happens with the Federal Reserve, but people can stop spending pretty quickly, right? So this is an important number to watch. 2/3 of the economy is driven by consumer spending, so that's super important. But it's ironically a weird contrary indicator right now to have consumer spending going up in an environment where you already have high inflation. So sometimes good news can be bad news. But today it's good news, apparently. If you look at the stock market, it jumped on this number and it's doing quite well. The market's still in this little range. So honestly, in my own personal opinion, it doesn't really matter what it does until it moves above that range or below that range. So you can attach all kinds of reasons for why things happen. But anyway, this is what's been going on. I do think this is a very fascinating, time frame in terms of looking at what's going on with the markets as a whole. And so, look forward to being able to talk to you again next week. Thank you very much. All right, Eason, now that we got our technical issues worked out, let's figure out what's going on with the questions.
So you talked about using a short position. How do you use a short position in a portfolio, and what are some of the risks?
Okay, so a short position, just for definitional purposes, just means it goes the opposite direction of something else. So if you short Tesla, if Tesla goes down, you go up, right? I mean, that's a short position. You can short the S&P 500 through an ETF. The one we use is ProShares short S&P 500. The ticker symbol is SH. So the S&P 500 goes down, you go up, right? And there's all kinds. You can short the QQQs, which is the NASDAQ Top 100. You can short international indexes. You can use leverage, so they have scenarios where you can short, 2 times, 3 times leverage. So theoretically, what would happen there, and it doesn't work quite as the way it's supposed to because it's meant for just a one-day move. We don't use leverage for this purposes, but theoretically, if it's a 2 times short, if the S&P 500 went down 1%, you might go up 2%, right? I mean, that's the idea, at least for that day. The leverage is not something we advise or use as far as that goes, just because I think there's too much risk there. So that is one of the risks. We do see a lot more people using leverage on the short side than on the long side. So that's a risk. Be careful there. Obviously, it's a risk if whatever you're shorting goes up, because then you're going to go down. And something can go up forever, right? I mean, there's no limit to how much the S&P 500 can go up. So, theoretically, you'd probably get out of it. But, if you didn't, you'd just watch that continue to deteriorate. And so that's the issue with those. They use futures contracts inside of these exchange-traded funds. So far, that's worked out well, but it's still something to, think about and be cautious with. I would probably be pretty diligent, in terms of how much I'd use, small amounts as far as that goes. But I tell you what, if you look at what's been going on this year, if you started off at the beginning of the year and you said, okay, what am I going to buy, right? What does well here? And there's all kinds of things that you might have said. Energy would have been a good answer, right? But it's been really struggling the last 30 days. I mean, a lot, down huge amounts. And so, maybe it's gold. Well, okay, gold's been struggling too recently. Bonds. That's supposed to go up when the market goes down. Not quite. We had one of the worst bond markets in history so far. What did well? Right? What did well was money markets or very short-term T-bills and those types of things. And, of course, the shorting did well. Obviously, if you were going against the market with the S&P 500 short, ETF, you would have made some pretty good money. And, they've come up with all kinds of different ways to short now. You can short the Kathy Woods, ARK fund. That's probably had a fantastic year because I know ARK's down a lot this year. You can now, I've read it. I didn't read the whole article, just a headline, so I don't know all the details. But they're now doing single stock shorting ETFs. So you can buy I can short Tesla by going out and setting it up where I borrow Tesla, right? And then I sell it, and then I go ahead and wait for it to drop, and then I buy it back and give back the stock, right? So that's short. But now you can make it a little bit easier by just using, there's an ETF that shorts specifically Tesla, which seems kind of wild to me, honestly. But that's shorting, and the risk really is just that kind of unlimited, potential loss, right?
Yeah, and you cap your upside. Once something goes to zero, you can't go negative.
Right.
So if stock's worth $50, at most you can make $50 if it goes to zero.
Right.
There's nothing more you can. So there's a capped upside while you have unlimited risk in a sense.
Yeah. It's just one of those things where sometimes, if you go back to 2008, which this market is reminding me more of, where you kind of had this slow rolling downturn, or even 2000. There weren't a lot of options. 2000 bonds did better. 2008, they didn't do very well. They've certainly not done well here. So there's just not a lot of places to go to make any money in this market. So that is one of the issues. But for me personally, if I'm going to move out of something, I'll usually move into something like a 3-month T-bill type ETF, very short term, and then I'll only use the short ETFs if I see economic deterioration on the leading indicator. So if I look at the Conference Board's LEI, leading economic indicator, and it's down by more than 1% from its peak, then I'll start using some of the inverse or short ETFs, just because the combination of a recession with a down market has created 40 to 50, 60% downturns, right? So just got to be careful here. I want to protect the portfolio. One of the big advantages of an inverse position is that it basically allows me, if I move 10% into an inverse and I still have 10% long, right, going the other direction, I now have 20% of the portfolio in a neutral position. But I only had to move 10%. And this is especially important if I have a high capital gain, right? Let's say I want to move 20% into an ETF that's treasuries. That's essentially the same thing. It's a neutral, but I had to sell 20% of the overall portfolio. And if I have high capital gains, which we do in a lot of our retirement accounts, then I'm having to pay a lot more tax. So that's where inverse position, I can just sell half as much, match it up against something, and I don't have to pay as much tax. Does that make sense? And so it just allows, it's a little bit more of a efficient tool as far as that goes, to be able to do that. And then going forward, we use a very interesting rebalancing technique where when things stretch downward, we basically rebalance. If I have an inverse position matched up with a long position, if the market goes down, one's going up, the other's going down, I rebalance, and I'm continually buying that long position at these low points using that RSI stretch. When the market does finally hit its low, I've now lowered the average cost of that long position. And basically, maybe my recovery comes back, faster. I get my account back to where it was at a quicker pace. Now, if the market goes straight up right after you buy the short position, you're in trouble. That's always true. So you want to make sure you've got your kind of stop losses in there. You just get out, right? You just get out of the way as far as that goes. Make sure you know what you're doing here. But there are strategies to take a look at inverse area. But again, I don't use them unless I feel like there's some potential for the market to really fall, kind of that 40% range. And again, that hasn't happened unless you see the leading economic indicators coming down at the same time, which is happening now. We do get another report on the leading economic indicator again, next week. So that'll be very interesting to see for June, because it's been down 3 months in a row. Was it down June also for 4 months in a row? Then you're really, historically looking at a point in time where the market could fall a lot farther. So that would be my, concerns as far as that goes. But that's where a short position, I think, can be useful. Don't have to do tons of it to have a lot of good impact on the overall portfolio.
So how much would you allocate? Would you kind of treat this as like a target, your target piece, so it's like a smaller piece of the portfolio, or do you start to really chop into like kind of like your equity? So like, say I'm a 60-40, am I putting 20% in the short,
right,
or am I in that kind of extreme, or am I going something smaller?
Yeah, exactly. So in our 60-40 portfolio, we have 4 target pieces at 4% each. So 16% of our equity is in target pieces. And so right now, 2 of those target pieces are in the short, right? And so essentially we still have the other 2, in this case, Microsoft and Apple. So I have Microsoft and Apple long at 4% each, and I have an 8% short position, more or less neutralizing those Microsoft and Apple. Then again, I can rebalance, right? And hopefully buy Microsoft and Apple at some lower stretch down points. And then the market hopefully recovers at some point and kind of takes off. And so that's where we are right now. The next step, though, would be to try to neutralize some of the other portion of the portfolio that we don't have out of the market. And that would be more in a severe scenario where we see, my personal feeling is if we fall past the low that we hit in June, we could see some kind of that capitulation, and which could really, you could drop another 10, 15, 20%, fairly quickly. I probably want to do a little bit more short in that situation to try to neutralize the portfolios. But again, we're not there yet. So it's a good question. It just depends on what you see. Honestly, I've said this before, but I feel like the biggest threat to the market is this situation in Russia and having Russia cut back on the production of oil and raising the price of oil 2, 3, 4 times where it is now. I don't think this is going to happen. There's some reasons that it shouldn't, but it could. And if it started to happen, that's something I'm going to respond to, because I'm talking about a massive catastrophe if that happens. If gas prices went from $5 to $10, I'm telling you, you should be careful with the market. Again, that hasn't happened, so we're not doing that, but I'm ready if something like that happens. So, we'll see how this plays out as far as that goes. The market is just kind of going sideways since that low back in June. Things could be fine, right? We'll see. Good. What's the next question?
So, could you go into a little bit more detail why you see gas being or Russian gas production being the biggest risk to the stock market, and it seems like a trigger event?
Yeah. So, I mean, that's the question I've gotten several times, is just, what's the biggest risk to the stock market? And right now, I see the situation in Russia as being the biggest risk, right? I mean, it's just kind of the way it is. Just because if you look at how it works, or how it's worked even in the 70s when we had this giant increase in energy costs, it's a really big issue because energy is used for everything. Look at what happened with Target, right? They reported earnings. They were supposed to be at $8 million, and they ended up at $5 million. And for the quarter, and basically the stock dropped 30% over a 2-day period. The number one thing they talked about was the cost of transportation increasing at a much higher rate than they thought. Means that their gas costs more. They transport it in different ways, probably diesel too, but nonetheless, it goes through everything. And so what would happen is that a company like Target can, if their energy prices continue to go up and up and up and up, they're only going to be able to raise the price of their goods to the consumers to a certain level before they can't raise them anymore. And then their costs are still going up, and all of a sudden their profits disappear. And the consumer is going to be under pressure because their cost for energy is going up, right? It goes everywhere. It's in every part of the whole equation here. This is a fantastic reason why we should get off of this whole oil train, because it's set on a global basis. Why don't we look at some of these clean energy things and some energy independence? Because even here in the U.S., we produce enough oil to support the U.S. It doesn't really matter because the price is set on a global basis. And Europe's in more trouble than we are in that regards, but it's really interesting. So I see this whole scenario of Russia weaponizing oil as a big risk. Now, and again, J.P. Morgan's stats are fascinating. If they cut back 3 million barrels, they're currently doing 11, so if they cut that back by 3 million, J.P. Morgan's estimate is price of oil go to 190. That's dramatic. If they cut back by 5 million, the estimate was 380. That's more than dramatic. Yep. That's ridiculous. And so now think about that. Why would Russia cut back their own oil? They're making money selling oil. Well, if they cut back their production by half, right, and the price goes up by 4, they make more money, at least for a little while. Yep. And so the one reason I can think of why they wouldn't want to do this is because that 5 million barrels of oil probably gets replaced in somehow, some way. Not right away, and the market drops based on that. But in the relative short term, 6, 12, 18, 24 months, something like that, we replace that 5 million barrels. Whether it comes from Venezuela, Iran, new negotiation there, some from Saudi Arabia, combination of all of them. And there are going to be people coming out of the woodwork wanting to sell oil at $300 a barrel, right? And so then what happens is now Russia is not selling that, doesn't have a customer for that 5 million barrels. They've already found other suppliers. And so that's a huge issue, right? I mean, that would be a problem for Russia. Longer term, Russia could really suffer from that. But you could say that about Ukraine invasion, and they did it anyway, right?
Yeah.
And they continue to do it.
Yeah, the idea is like do I want or do I want my supplier to be unreliable? And
Yeah.
like Russia's starting to show, are they going to be a reliable supplier? Can I depend on you to be my
Right.
supplier?
Right.
And as a business, if you're thinking about a country as a business, if this country I can't tell them every month how much supply I'm going to get, I'm going to find an alternative source that
Yeah.
I can predict.
Yeah, exactly. And although reliability in that whole world is kind of a weird deal, right? I mean, so now Iran's going to be the reliable one, or Venezuela, or so it's why clean energy should probably be considered more, because it gives energy independence to that specific country. I mean, Germany really made a mistake here with their reliance upon Russian oil, and they'll eventually rectify that, but it's going to take a really long time to figure that out. And so anyway, it's a fascinating concept, this whole thing. So I see that as the stock market's biggest risk, is the possibility of Russia weaponizing their energy. They've already started. There have been several different things. The Nord 1 pipeline is closing down for scheduled maintenance, I think right now, actually. And I know I read articles where in Germany they're really worried about the fact that they might not turn it back on. We'll see how that plays out. That would be big time. That would be a huge deal. So anyway, keep your eyes on that ball and make sure you understand what's happening there and be ready to get defensive if those things continue to deteriorate. Might not happen.
Yep.
Right? It really might. Might not. There's some reasons why not. So but that's the question. That's the answer for me anyway. All right, what do we have for next question?
So the next question came in from Sammy on a comment in one of our videos is, recession causes oil usage to go down, and inflation causes commodities like oil, gold, and silver to rise. Is also true, but what wins when you're kind of putting them against each other? What are your thoughts on that?
Okay, so oil hit $130 a barrel after the invasion. It's now at 97. And it's dropped a lot just in the last, say, month, 6 weeks. And so always remember that the markets are looking forward. So inflation's right now, right? That's an issue. But the markets are looking forward. And so the markets right now are pricing in the possibility at higher rate of a recession. In a recession, there's less oil used. So in this environment right now, the recession beats the inflation. It's possible, what they call stagflation, right, where you have no growth and a situation where you still have higher inflation, mainly because especially in the area of energy, it is set on a worldwide basis. Mm-hmm. But it's pretty likely that we're going to have a worldwide recession, honestly, in my opinion. If we have one here, it'll be other places. Matter of fact, Europe probably has even more threat of a recession than we do, and might contagious to us as far as that goes. So I think that recession wins in this particular case because recession is the forward-looking thought process that the market's looking at. And so it's looking longer term down the road and is saying, okay, recession's coming, there's going to be less oil usage, and the price of oil has been coming down, for that. There's some other reasons too. Obviously, there's always many variables coming in, and the COVID lockdowns and the threat of more COVID lockdowns in China is a big issue. They're a huge consumer of oil because they're one of the biggest, kind of the world supplier of goods. And so when they cut back, they use less energy, there's less cost. So there's kind of the combination is happening there. But the question was, inflation makes the prices of commodities and oils go up, recessions make them go down. Who wins? Right now, I think it's recession that's going to win here, unless we don't have one. Mm-hmm. Right? And so that's the key. That's the difficulty here, because if we don't have a recession and we continue to have inflation, then commodities and oil and those prices will continue to go up. But look at the Federal Reserve. I don't think they're going to allow inflation to go and go and go. They're going to kill everything in sight trying to get inflation down. I think that's a mistake, but I think they're going to do it anyway. Mm-hmm. And if they have to go 3/4 and 3/4 and 3/4, whatever it takes. And so eventually, because these increases that they're doing are delayed reactions. So in other words, we don't see this set 3/4 point increase that they're going to do here, in July. We might not see the real impact of that until January. So they're levering these things up without really knowing what's going to happen in January. We might get to January and realize, oops, we've done too many. And, whatever that is, maybe it's the first half of next year, at some point in time. And this is the typical pattern for the Federal Reserve, is that they overraise rates, they create this big downturn, and the market is actually pricing in some decreasing of rates for the end of the first half of next year already, this time next year, as far as that goes, for that exact reason. Overraise rates, get inflation down, but then it just starts to go the other direction, and inflation comes, and recession comes really hard. And so if that happens, it's hard to imagine commodities and oil and what have you doing great there unless we see something from Russia. Yeah, they could do something there too. So, that's why I don't play that market that much. There's too many weird variables that can come out of left field. You look at a Target, which got hammered. They're a great business. I'd rather buy Target than oil, personally, just because it's more defined. That's a company that's actually trying to make money. They're not invading anybody. There's no there's no weird players like Iran and all these things that are in there. That's why I don't really play that market that much as far as that goes. There's too many ways that somebody can change the calculus that you have overnight. Mm-hmm. Right? If Russia decides to cut back half their production tomorrow, it's going to go up in price, and you would have made money on that energy bet, right? But if if all of a sudden Iran comes online and Venezuela comes online more, so things can change pretty quickly there, and all of a sudden you've got a lower price, or a steep recession kicks in and less energy, or COVID lockdown. There's too many pieces there that are out there that I don't play that game. All right. What do we have for the next?
So our next question is a pretty common question. I've always thought about retirement at 65, and I've kind of got stuck to that age. But now that I'm in my late 50s, I'm starting to think about, what if I retire early, or what if I retire late? What would that effect be on my retirement?
Yeah, so this is a question that comes up quite often. We've dealt with this on a regular basis. When can I retire, and how does that work? And this is what a retirement plan is all about. Mm-hmm. It amazes me how many people just retire. I've run into people, and you ask them why they're going to retire. Well, I'm 65. That was the most common question. I don't hear that as much as I used to, because planning has become more, common. But it is kind of amazing, they know some things. I'm going to be able to get Social Security, and I've got this money, but they don't really know if it's enough, and what you should know. You're going to pull the plug on some career that might be hard to get back to, potentially. And by the time you figure out that you don't have enough money, or there's some big downturn that came that you weren't expecting, you might not be able to get back to that career. So I'd want to know up front, and that's where kind of the Monte Carlo simulation comes in on the financial planning. I'll give you an example here. I'll share the screen. Let's share it this way. This looks better. There we go. And so what we're looking at here is just, sitting down with a 50-something-year-old, wants to know, can they retire, early, mm-hmm. right? And here's the parameters. I want to spend this much. I've got these assets. I've got this income. Here's what my Social Security looks like, And so, can I retire at 62 instead of 65, right? That's the question. So we put it all in. We run the Monte Carlo simulation, kind of push this button, and here we go, 48% probability of success. So basically, your retirement at 62 with those parameters is a coin flip.
Oof. Yeah, not something I want.
It's a coin flip, yeah. So get out a coin and flip it and see if you're going to make it or not. Because all of those red ones there are where you ran out of money before you ran out of time. That is a bad scenario. And if you look, they don't happen right away, which is even worse. It means now you're 80 before you run out of money, which mm-hmm. are even harder to get back into the workforce and those types of things. I want to know this when I'm in my 50s, making this decision early, this is the way to do it. And so this is, we go through the process. What do you want to spend? What are some of the assets that you have? What do we have for outside incomes like Social Security, rents, pensions, those types of things, right? And we run the Monte Carlo simulation. So that's number one. Now, we might take a look at that and say, okay, so if 62 is still of interest, still very interested, burned out on the career, wants to make sure we retire earlier, have a better long-term retirement, maybe we look at kind of negotiating, the amount of money that's going to be spent, right? And so if we lower the projected amount of money that we would spend, and we look at maybe a little bit different lifestyle, and sometimes it's not a huge difference. It can be like a 10% difference, 10% less, right? And you can retire at 65 instead of working 62, instead of working those last 3 years. And so then we run the Monte Carlo simulation again, and we push the button. And so at this lower, income level, oh, there we go. Okay, so if you want to retire at 62, right, retire early, then we have a scenario where you've got 96% probability of success.
Yep.
If you're able to spend this lower amount.
Yeah, and so that's kind of like your levers. If I retire later, I can spend more money per year. But if I want to retire younger, then I'm gonna have to kind of lower that out or spending.
Right.
And so, I think people got stuck to that age 65 was we had a pension. People with pensions kind of had this fixed income that they knew about every month, and so. But now most of our retirements are market dependent, and so it's a little bit more kind of variable.
Yeah, exactly. I mean, now what we're showing you here is a scenario that doesn't work at 62. It doesn't mean yours won't.
Yep.
You could be in your 50s and we run it. You could be at 96% with the exact amount of money you wanted to spend because you have enough outside incomes and or assets, right? We've seen that.
Yep.
We've seen these plans. But it's really important to know that before you get there and before you do anything. Now, this particular example that we're using here is a person who's in their 50s looking to retire at 62, right?
Yep.
So let's just say that's 5 years from now. You're 57, like me. Oh, actually, I'm 58. Never mind. I forgot. What that means is I've got this 5-year period. I'm looking at this. It will work. I can retire at 62, but I'm going to have to spend a little bit less money than I was hoping to do. But you still have 5 years. So you could really be motivated maybe to put more money away, to save more money. And we've seen this a lot. People in that last 10-year stretch before retirement, because, man, I'm going to try to get enough money put away and saved up, and we can figure out what that is. We can tell you, okay, you need an X amount more money to make it work, at least in terms of Monte Carlo simulation, to get to a situation where you can retire at 62 with the amount of income that you were targeting originally. And we've seen people do unbelievable things in that environment and really, really save and go for it and, and invest and do all these things that might make that happen, right? And so I think that's what makes this so powerful altogether. It's just the understanding of what works, what doesn't work, yes or no. If it doesn't work, what does work? Okay, good. And then how much would I have to save to make it work? Because I still have time. This is not a person who's retiring next year or what have you, right? In this particular question. So it's a great question. It's a really powerful piece of what we do. This is where you can change the rest of your life.
Yep.
Really. I mean, basically come see us, talk about these things, and be able to really, understand where you're at, what you can do, what you need to save to kind of get where you're going. And it's fairly well defined. It's not just some random thing where just, oh yeah, that sounds good, and maybe that'll work. Or this is a Monte Carlo simulation. It's pretty powerful. We've been using it for long enough to be impressed ourselves, and hopefully you're impressed by it also. So anyway, that's what we would look at as far as an answer to that question.
So the final question we have is, I'm having trouble seeing the big picture in the market, and I'm only seeing red for the year. How do I kind of reframe this thought process?
All right. So this is a very common one, right? I mean, people are worried about the market. It's been a pretty brutal market. especially when you consider what's happened with the bond market. So, our clients are average 60% stock, 40% bond, and usually the bonds kind of offset some of the stock losses in a lot of these downturns because people run for the bonds. In this environment where rates were down to zero, they're having to raise rates so much it's killing both the bond and the stock market, and people are worried, right? So let's do one thing here first. Let's just kind of start with a little bit of a longer term perspective, because it's super important to understand how the stock market works. If you're seeing red all the time, great. You probably, are still doing okay if you've been in it for a while. And hopefully, if we look at 5 years from now, that'll still be true, right? And so if we look here, this is a 5-year chart of the S&P 500. And this is specifically the S&P 500. You can't actually buy the S&P 500. You can buy an ETF that replicates the S&P 500. Vanguard has one, VOO. Spider has another one for SPY. So this is the 56% rate of return on the raw S&P 500, index since the last 5 years. But look at what we had to go through, right? If you want to have no red and no worries whatsoever, you put everything in the bank. But you're going to lose to inflation. And so then people go out to the stock market because they want to keep up with inflation and beat inflation. Two big areas are real estate and stocks that do well long term to kind of give you enough assets to keep ahead of inflation over the long term. But there is a cost, and that cost is this variability. So if you look at that first V downturn there, that was 2008, almost 20%. 2018, sorry, almost 20%. That obviously the second big one was the pandemic, 2020. And now we've seen, we peaked out here at the beginning of the year, and we've got this kind of rolling downturn, more like the 2000 and 2008 downturns. Still up 56%.
Yeah, that's pretty good.
You put 100,000 or a million or whatever it is you have into the S&P 500, you're pretty happy after 5 years, unless you focused on what you had at the top.
Yeah.
That it happens all the time. My clients, we're down, 100,000 or whatever it is, right? And it's like, okay, yes, that's true from the very highest point that you had on your account. You are down that much. But if you go back farther, you're up a lot. And so that's one, broaden the perspective if you're having trouble with what's happening here, and realize that this is part of the normal motion. And that blue line there is the average for every 200 days. So every dot on that line is an average for the 200 days prior. That's pretty smooth.
Yeah.
So, and look at the direction of it, right? Right now it's kind of curling down, but overall over that 5-year period, it's been a nice smooth ride. And so really the problem is we see the daily, the churning that's happening and all this stuff. And that's what, makes me calm. My clients are always telling me, I do all these videos. I do a video every day on what's happening in the market. Then my clients are always, you look so calm. Well, it's done pretty well. My entire career, we've had lots of downturns, but it's higher, pretty much all the time. I mean, there was a bad 10-year period that ended in 2009. That was brutal. But it's up from there, so it's just a matter of kind of hanging in there and letting things happen as far as that goes. So good stuff. Appreciate everybody attending today. Look forward to being able to help you again next week. We have this live show every week from 12:15 to 1, and really hope that you got something great out of this today, and look forward to seeing you again with your next week. Send in questions if you'd like. Anytime, happy to answer them. Subscribe to the channel, hit the subscribe button, or go book an appointment with us, and we'll be able to help you with your personal problems, maybe do some Monte Carlo simulation for you or what have you. So look forward to seeing you next week. Thank you very much.